Man, I had a great afternoon today. Get some great calls with a few investors that I'm looking to line up for my investor club. That's coming along really well. But today, what I wanted to do in Tech Sales Thursdays, this is workshop number two. I wanted to be able to kind of go a little bit into the nitty gritty of what exactly is underwriting, and I'll kind of back up and start at a big picture point of view and zoom into why that's relevant and how we get into that. So first, the story I like to tell. Let me move my screen here so that I can see, and I should be able to see if people are questions. If you're checking this out live, you should be able to ask questions, and I will see your questions and be able to answer. So, I guess first big picture I want to kind of paint for people is, if you're new to me or new to what I talk about, I help tech sellers become financially free by helping them invest in low risk passive real estate. And we do that through a number of means, but it all starts by getting educated, right? And I shortcut the process for you by putting everything I know in this book called Surbage You Can Quit. So allow the commercial plug. And the purpose of the book is to shortcut what took me about 8 years and many hundreds of thousands of dollars and many, many, many hours, hundreds of hours of understanding and learning and trial and error to be able to distill it down to kind of paint the picture for what our problem is as a seller and what the opportunity is and how we kind of solve that. So what our problem is we've got a high stressful job. We've got a lot of variability, the economy, accounts, territories, organization. I was just talking to a club member of ours, and he was just saying how he had a great year, made President's Club, talking about you, Mike, President's Club, and his territory is changing, and that could be for the better or for the worse, but he won't know until he starts going through it. And therein lies the problem, right? And then the other problem too is as you start making more and more money, you'll start paying more and more in taxes, which isn't fun for anybody. So the name of the game is to take the money that you make in sales and invest that into low risk passive real estate opportunities. And that's what I help you do. And the reason why you do that is because you want to take the cash that you're making, put it in these projects, and have that money go to work for you, so that one day you don't have to keep working to make money. This money's out there working for you. So that's the name of the game. And I go into it more and more in the book, but at a very high level, that's sort of how that all works. So what I wanted to get to in the training here is just kind of walk through what underwriting is. I think people hear that word, especially if you're like working with an insurance company or something like that. But oftentimes, if you're not an active investor, it doesn't make sense to you. What the hell is underwriting? Well, underwriting is the process of reviewing, analyzing a particular opportunity. I'm just going to keep it very simple here. And so I'll give you an example here. Let's say you want to invest some money and you want to I don't know, you want to buy a rental just for argument's sake. You're like, hey, there's a house down the street or house by the lake, and I figured if I can buy that house, I can rent it out. It'll pay for the mortgage, for the expenses, and then I'll be able to use it a couple of times a year. Great example, right? So you take your little napkin out, your pen and paper or spreadsheet. Be more advanced with the spreadsheet, and you write down, okay, I expect each month, if I rent it out, I can collect $2,000 a month. And I should be doing math live here out of my head because I'll get in trouble. I can get $2,000 a month if I rented it out. I'm going to take 2 months out of the year and allow myself to live in there. So that would be what's called it's 2,000 times 12, $24,000 a year, but 2,000 a month. Sorry, 2 months out of the year, you're not collecting any rent from it. So that's $20,000 that you're getting. And we'll assume the expenses are relatively cheap. I don't know, $1,000 a month. So you're going to net 5 grand, argument's sake. So you'd write this out. You'd show your revenue, your expenses, what your profits would be, and you would just kind of make assumptions there. That basically is underwriting. Now, there's some more detail in that. You would verify things. So, for example, if you would put a placeholder for property taxes, okay, property taxes, they're going to be 2 grand a year. Great. Well, how do we know that? We had to verify that. So we go to the county assessor's website and we look and see what the property tax is, and we verify that it is going to be actually $2,000 a year. We look at the utilities and things like that. So we really kind of have to verify the information that you're using in your assumptions. That's basically what it's for. And the whole point of this exercise is to see, is this going to be a profitable venture? I'm wearing 2 sweaters today. It's super cold. Is it going to be a profitable venture for me to go down? And at the end of their underwriting, it should tell you, yes, you're going to make money, or there's a high likelihood of making money, or no, it's not. That's a big difference in temperature by taking this thing off. All right. So That's what it is. And what I was going to do, and I will do it as I talk in past tense, is I'll show you our underwriting model. It's a little bit advanced, but I think people like to know how the sausage is made. At least I do, right? And so a lot of this is all for me anyway. So give me a second here, and I'll show you what I'm talking about. All right, cool. Let's get my screen share here. Turn on my Excel. Now I will tell you. Um, the things that I'm going to show you here aren't necessarily a requirement for you to understand completely as a passive investor. But I like to show this because I think it's important to have an understanding of how some of these things work. And and plus it's just interesting. So let's start with this. So let me share my screen as I keep saying that. Share screen. Let's do this screen. Hold on. I got a couple of things I want to show you. Hold on. So let's first start with, where's my downloads? There we go. All right. So the first thing I'm going to show you here is what's called an offering memorandum. Before we get into underwriting, let me share this part. We'll do this entire screen. This one. There we go. All right. That should work. Ta-da. Okay, cool. So this is an actual offering memorandum, or an OM, as we call in the industry, of one of our properties that we've got. This one is in Ohio. So I'm not sharing anything that's super secret here, but it's a marketing package that's put together by a brokerage. In this case, Marcus and Millichap put this together many, many years ago when we acquired this portfolio. It's 276 units in Shaker Heights, Ohio. And the way this works, this thing is meant to kind of give you, as an investor, a quick glimpse into what it is that you're looking at, right? Like what is the investment opportunity? What are the market rents? Just kind of a high level view. And this, because it's a portfolio, has a number of properties, which you can kind of see listed here. And the sum of this is like 278 units. So in here, here's what the buildings look like, and here's what the value add program looks like. Here's where, if you invest this money into the property, and you do these sort of fixtures or finishes to it, you can expect to push the rent from where it is today to another number. That's really how you kind of force appreciation and increase value with these sort of things. So at some point, there will be this thing, this part, this kind of historical operations and some rent roll stuff. And this is what I'm going to get into today, at least show you what it's about. And I know you can kind of barely see this because it's like chicken scratch view. There's a lot of data here. But essentially what happens, the broker will provide you with information from the seller about the property, the financials. It'll include what's called a rent roll, which is this piece right here. And I'll zoom in to show you what it looks like. This is called the rent roll. So in this case, we've got, I'll zoom in more. So we see here, this is particularly the property, the unit type, the 1 bedrooms, the 3 bedrooms, how many units there are there, the square footage, what the rent is, the in place or the market rent. And the idea is that you're able to extrapolate, well, look, if market rents, for example, here are, this 1 bedroom, 2 bath is $840 to $982 of the current. Let's not use that one. Use the first one, the one ones. So it's between 827 and 850. That's what's on the rent roll. That's what the actual average rents were at this point in time in 2019. And the market rent is probably about 900 bucks, right? So it really isn't too much of a difference between, this and this. Well, actually, there's $50 there, right? And you would look at that for each apartment, each unit. And you're going to use that to extrapolate what is the in-place numbers today and where can we get to if we improve the property. That's how this works. So we take this data and we feed it into a kind of sophisticated spreadsheet. And I'll show you that here in a second. Here's the spreadsheet. So this is even more complicated than the other one, but I'll walk you through how this typically works. I'm not going to go through every single thing, but I'll walk you through. This is our sheet that we used when we were acquiring properties. So you fill in some basic information, the name of the property, and I hid some. There's a real data in here for a property that we underwrote for purchase, but I've kind of anonymized some of the things in here. So we put in the property information, the area income, what the purchase price would be. This one particularly was about $20 million. So that's about $94,000 a unit because there's 211 units. And then we put some assumptions in here because the way these models work is based on assumptions. And what you want to look for, what we look for, is you look for a deal where the people putting the deal together, they're called sponsors, they're putting as much conservative assumptions in here as possible. And I'll point out some of the spots where you can do that. So in this case, most of these deals, they are typical investments between 3 to 5 years. So we put a 5 year hold on this. That's how long it's going to operate for. We put in some assumptions on what the multiple is going to be when you exit it. I'm not going to get into cap rates right now. And then we go into some other things. So we talk about what the loan could look like. What is the leverage on that? How much of a loan, right? Because, in an ideal world, you'd be able to take out 100% loan, but you can't really do that. So, you figure if it's a $20 million purchase price, we'll get a $14 million loan. What is the interest rate on that loan? In this case, we threw in 9% and 3 years of interest only, some other stuff. Maybe there's a bridge loan, which is it's a different product that's used to fund a lot of renovations on these type of properties where there needs to be a big investment of capital improvements, new floors and elevators and kitchens and things like that, right? So you're able to kind of borrow money for that. And then you enter in all of the property information. Now, these descriptions are sort of terrible, but this is saying it's a 1 bedroom, 1 bath, 1 bedroom, 1 bath. And a lot of times this is pulled from the property itself. So we fill in what kind of unit type it is. Is it a 1-1 or a 2-1 or a 3-2, whatever else, the number of units there. And this now spits out and tells us out of this whole property, we've got 15% are made up of this special 2 bedroom, 1 bath unit itself. You put the average size of it, and then you're able to kind of put in the average rents that are in place. And then we also like to look at what the max rents are in place. And then, it highlights for us in green here if there's a positive difference, because what you're looking for when we're underwriting these kind of properties is you're looking for a property where the in-place rents today are at this number. Let's just call this, it's here, literally $912. That's the average rent. But we think the market, the max rents in the rent roll are at $11.99. So even if we did nothing, we just made all of the rents for the whole property match the highest current in-place rents today, then, that represents, what is that, $200 or so, a rent increase. And that's, without going into all the details, that's how we are able to increase the value of the property and provide returns to investors. So that's kind of what we look for when we're looking for this at properties here. Let me just make sure there's not any questions coming in. All right, cool. So we do that. We plug in some numbers here. We look at the rents. The next thing we do is, we're not going to do rent projections. We put in what are called the T12. And I won't go into every single element here, but I'll give you the high level view of what we're trying to do here. So I know there's a lot to look here, but let's just focus on this. And I'm going to just highlight these highlighted things. So when we get financials for a property, we look at how much money is coming in at the top of the line, how much revenue is coming in. So we have income. I don't want to get into these things because they're like negative numbers in a category that should be positive. It's for another time, another day. But this whole top line is our revenue. And then, we also look at other income. This is other revenue that we collect that is what are called other income. So that could be things like application fees, as you see here. It could be laundry room. Some properties have a laundry room making some money, pet fees. If they early terminate their lease, there might be a penalty fee that they pay, things like that. And so there's a total subtotal of that. This is called total other income. And then there's some other income there, and it ultimately culminates in this bottom line here, which is this number that I'm showing you right here. This is for each month. So January in 22, they were getting $166,000 a month. And then they did the same for February. March jumped up to $191,000 a month. Then it kind of dropped into April to 169. And there's always this flux that goes on. It's never usually the same consistent 166,000 each month. That's make believe. There's always going to be this fluctuations there. The name of the game is to even out those fluctuations. But these are people we're dealing with, and they have lives, and things happen, as they say. And so that's all the income. Then below the income, we've got the expenses, and the expenses are usually broken out into many, many subcategories. I'm not going to go through all of them, but I'll highlight a couple of them. So we have maintenance and repairs, and that could be things like replacing the door locks. It could be air conditioning repairs, or maybe plumbing repairs. Sometimes roof repairs are in there, so that gets all summed up. Then there's make ready or turnover. That's the typical cost or category that goes into making apartments ready when someone moves out and when you're getting it ready for someone to move in. That's called make ready. And that's typical, part of the business there. Utility expenses. Now, what's interesting about utilities, not to get too advanced here, but utilities can sometimes be billed back to the renter themselves. And it depends on the area, the state. Some states it's illegal. Some states you can get away with doing that. And it's also market dependent. In some markets, right, where you've got a bunch of apartment complexes, if you're the only one trying to bill back for water and sewer and pest control, for example, it might be a tough pill to swallow because the rest of the market isn't doing that. But if the converse is true and you're the only property that's not doing it, everyone else is, there's an opportunity for you to be able to create more value for the asset itself, for the property. Then there's other expenses. I'm not going to go through all these things. There's a lot there, right? And so at the end of the day, you're going to kind of calculate what are those total expenses. So remember before we had 166K coming in for the property in revenue. Well, this has had $35,000 that same month of cost. So that leaves you with $131,000 of, for the purpose of this discussion, your net operating income, your profit there. And so 131 for January, 118,000 for February, 172 for March, and so on and so forth. Then you had a bad month, looks like in April, drink some water here, of 70K. And so what we would do is, as we're analyzing this, we would say, well, geez, what happened in April that caused there to be such a big dip? I mean, that's, what is that, $50,000 on average, or even more? I mean, that's $100,000 dip from the previous month. And what I suspect that happened was there was some kind of there was a big cost that happened and it got rebalanced. So the property insurance is what caused the big increase in it, but then it balanced out in the following month. That's why there was this big swing. So we kind of look at all those things. And then, when we look at that information, then we go through each of these items and we say, all right, where can we cut some fat? Are they paying too much in, I don't know, what's a good example here, in their advertising expenses? Is it realistic for them to spend on average, I'm just picking numbers here, $2,300 a month? Is there a way we can reduce this down to $2,000 a month and trim some of the fat? Maybe the trash disposal is a bit high. What are they paying right now? They're paying on average $2,800. Maybe there's a way to call some of the trash companies in the area and see if we can renegotiate the terms of the contract, right? And being able to do that is how you add value by cutting expenses. Because at the end of the day, in apartments, the way these properties are valued is in this bottom line here. This whole total net operating income, this NOI, which I get into in my book, Surbage You Can Quit, explaining how all this works, is how these properties are valued. And essentially, this just means the cash flow of the property. Now, it's not entirely true because there's some below the line figures here, but for the sake of argument and the sake of a discussion here, these are the numbers that dictate the value of the property. And so there's two levers that we have at our disposal to increase this bottom line number. If you're paying attention, it was revenue, right? How much we charge for rent or other fees or things like that. And then, of course, controlling our expenses as much as we can. And if we can do that, that will improve, ideally, our net operating income and allow for cash flow distributions to our investors, or increase the value of the property so that when you go to sell it, you can sell it for a higher multiple than what you bought it for. So I'm going to push pause real quick, get a drink of water. And I'm going to just check out, make sure there aren't any questions in my LinkedIn here. No, nothing yet. That's cool. Yeah, reload that. We'll see what happens. All right, cool. And so let's see what I can get into. I think I showed you that. Let's see what happens next. So we filled out the input tabs. We showed you, this is for renovations here. Just trying to think what else I could show you that would, I guess I could show you the actual cash flow calculations. Yeah, that's fun. All right, let's do that. So as a recap, the purpose of doing this, right, doing this process of underwriting is to identify whether or not this particular project, example, Hidden Harbor, is a sort of opportunity that we want to move forward with as a group to acquire, right? Is it have the ability to make enough money that I can attract enough investors to want to invest in this deal? And I'll tell you right now, based on the numbers that are in here, that we see here on top, being able to give our investors roughly a 5% return is not enough money. it's not going to cut the mustard. So what we'll do is we'll look and see, well, where else can we optimize the deal a little bit? And this is just again, this is taking a master class of underwriting, which takes a long, long time, and just distilling it down to a 25-minute workshop. I'm skipping over a lot of things for the sake of just keeping it interesting without boring you with details, but just kind of again showing you what happens behind the scenes here. So these things that you see here, these are all escalations. So we're assuming that in the next few years, we're going to increase, the cost for gas and water and sewer and management fees, and just baking in these escalations of increased costs. It's basically inflation for costs, right? So we're assuming that into the model here, the financial model. We assume that there's a certain level of vacancy. Being conservative means you want to assume there's going to be less people actually living in the apartment complex than you'd want to, right? Because how is this property going to weather the storm if for some reason there's a shift in the marketplace and you're having a hard time getting people to pay rent or get a lease, right? To get a lease in the first place. And then there's this is just a breakdown, it's pulling data from the top of the spreadsheets here and kind of spelling it out here. I'm also getting some messages here on LinkedIn, I think, on my phone. So I'm trying to do both, maybe. Nope. Okay, cool. And then, so here's how this kind of works. So at the end of the day, we take all of that micro data, right? The monthly, the unit rent, the unit possible rent, the monthly total amounts that are going in for revenue, the monthly total amounts that are going out for expenses, and we roll that all up into just a yearly number. In this case, year 1, year 2, year 3, year 4, and we are able to kind of break down and see all that stuff on a month by month basis, but I'm not going to bore you with that. And, we kind of look and see, well, where is the potential here? In this case, this particular deal, we're assuming it's going to go from where it currently is. And I don't remember what that number is because it's not in front of me right here, but we're going to get it to about $1.2 million of bottom line net operating income. And then we're going to increase it by about $200,000 the following year, and then another $200,000 the following year after that, and then the 100 or so. What happens is the reason this kind of trails off is because it becomes really difficult to forecast what the rent increases or all that stuff looks like 3, 4, 5 years on the line. So in that case, you just kind of assume, hey, best case, 2%, 3% increase. That keeps in line with inflation. That's industry standards. That's normal, right? But in the first couple of years, that's usually where there's going to be the biggest boost in NOI. Now, a good conservative group will also tamp down those assumptions there and kind of expect them to be a little bit lower, right? Be more conservative because, as I've seen it, things happen. Things happen. They kind of get in the way. And then this feeds into our model to tell us whether or not there's actual cash flow. So I forgot, it's been a while since I've used this. So in this particular project, we're assuming, and this wouldn't really work out very well for investors. It doesn't really scratch the itch, and that's why we didn't go after it. This one would model out to be a 1.3x return. Now, to give you some comparisons here, and I've got 7 minutes left here. Typically, for large apartment complexes, you want to look for a return multiple, and I'll explain what this is, of about 1.8 and above. It basically means you're going to get close to doubling your money or over the course of this project. And that's pretty typical for most apartment investments. The goal is to get close to doubling your money in 3 to 5 years. That's kind of really it. This one doesn't exactly do it. It doesn't lose money. You basically make 33% on your money. The project does over the course of these years. Which is an average of 5.5%. It's not really that great. So this is why we passed on it, right? So I hope you found that to be enlightening. I enjoyed getting back into doing the underwriting things. I used to spend my days just digging into all these things, and it would take me on average of 3 to 4 hours to break down these things, to be able to go through all this stuff in detail. There was a lot of work, but there was a lot of, at least for me, intrigue of trying to, it was almost like a mystery, right? You get a deal presented to you. There's these numbers. It looks good. If you go to the broker, you got all these cool pictures and you see the potential. And you're like, all right, cool. How do I make this work? And then you take all the numbers and you feed it into the spreadsheet and you run through it, and you're like, this is a dog. And really, the only thing that you have to do at that point, the only variables that you have fundamentally are the purchase price, right? The only way you can make this deal work, I'll show you. For example, here, if I'm going to get a look at this leveraged IRR number at 6%, right? If I change the purchase price, they wanted, what do they want? They wanted, nope, hold on. Yeah, they wanted 94,000. Well, let's change that to 80,000. Now we go to a 17% return. Went from 6 to 17. That is way more acceptable. That's easier to sell, if you will, to investors for the potential to make some money. What would that look like for the cash flows too? Let's look at that. These aren't terrible. So with this deal, what worked out, it was a 2x, like we talked about. So we're at 2, we're doubling of your money in 5 years. And this would have been a about 5.8% cash in year 1, no cash flow, not sure why, in year 2, and then there was a refinance modeled out in here. So the way the refinance works is we force so much appreciation on this property that we're able to go to the bank and get a new loan on it. So if it was valued at whatever, $18 million, now it's valued at $25 million. And we were able to take a new loan out based on that new value. And so your mortgage payments go up, but you pulled out a bunch of tax-free cash, which is awesome. And then from that point on, for the next couple of years, you're paying 8%, and then you're getting 152% of your money back because of an exit, meaning you sell the property. And that's kind of really it. This is sort of like the blueprint for doing a typical value add apartment deal. And again, value add means you're trying to add value by making a better product in the marketplace. Not all groups do that. Some groups literally just come in and just charge higher rents without actually providing a better experience for them. And not that I'm judging or there's a right or wrong. Everything sort of has differences in between it, but that's one way of doing it. Other groups like to actually invest in the property itself, and it all depends. I don't want to cast judgment or whatever, throw stones. It's a complicated subject, and I don't want to get into it for this call. So with that, I will kind of get to the end here. If you watch this thing the entire time, I want to give you a special treat. And I should have teased it earlier on, rats, for next time. If you would like to check out my book, Surbage You Can Quit, you can do that. You could DM me and request access to a free copy of it. I will give the book away. You just got to cover shipping, and I will put this in your hands. These things have been flying off the shelves. I think I got 4 out this week already, which is fantastic. Now, for those of you that are not bookworms and you're more of an audio bookworm, I do have a special offer for you. If you don't want the physical copy because you don't like physical books, that's fine too. I'm a physical book guy. If you DM me the word "So Rich You Can Quit January," I will give you a special link that you can use to download a Spotify redemption code and listen to the audiobook on Spotify for free. So let me know if that is interesting for you. Otherwise, I will be back doing this workshop with Q&A. I'll have some more Q&A beats. That's next time. I kind of went into the weeds of underwriting. Next Thursday, actually, I won't be doing next Thursday. Next Thursday, I will be traveling, doing some sales stuff. And I will be back on the following Thursday after that. So I think that'll be the 30th, I believe, at the end of the month. Will be the next time I'll be going live on LinkedIn. So if you have any questions between now and then, feel free to DM me on that, and I'll bring it up on our next workshop call. Thank you so much for checking this out. And this has been fun. I'm enjoying doing this. It'd be more fun having some participants in here throwing some questions at me, but I know this is workshop number 2 or 3, so it's all good. Rome wasn't built in a day. It's totally fine. And now you get to look at my pretty face until this ends at 3:30. Oh, man. No, I'll end it now. All right. Thanks, everyone. I will see you soon. Where's the stop? They hide the stop button. There it is. Bye.